Hello and welcome to the No Pricks Allowed podcast with your host, Aaron Buchner from Cactus. I'm Wendy McConnell. Well, hello there, Aaron. You said you had no idea what you're going to say. I want to see how quick you come up with something.
No, I have no idea what to say.
Oh,
I can
that
talk
was
about
quick.
yeah, it was so quick. I could talk about my weekend of bond spieling. I can talk about that.
Is that a band?
No, that's curling.
Ugh.
So a curling. What's with that face?
What is it with Canada and curling? Is it because it starts with a C?
Could be. It's a fun. It's on ice. It's just given to us. Come on.
I watch it once every 4 years when it's in the Olympics.
Should watch it now. And well, I don't know if they show it in the States. So but right now it's a big thing. Well, it's winter here, so it's a big thing. But right now they just finished the Scotties, which is the women's national title, and then they've got the Brier starting this Friday for the men's. And then I just had a tournament on the weekend, so I'm sore and bruised, surprisingly, from curling.
So you play?
Yeah, I play. Yeah.
Oh, okay. Well, good for you.
You have a new appreciation for me and my craziness? It's like, yeah.
I don't know, appreciation is the right word, but I got to know something. So today we're going to be talking about insurance.
Yes, we're going to talk about some life insurance. I figured continue from the previous talks. We've talked about critical illness the last few times. So I'm like, let's talk a little bit more life insurance. I know it comes up. I actually have a conversation later today with a client who's looking for life insurance and they want to understand it. And I know there's so many questions people have about how much insurance, what type of insurance, why should I get it, why do I need it? So I figured let's dive into that and kind of give people some education on life insurance and why they should have it.
Okay, so who needs life insurance?
This one's always a fight because some people say everyone should have it. I don't think everyone should have it because there are I would say there's kind of rules in there, or I don't like rules. So guidelines of what people should follow in terms of if you should be considering getting life insurance for yourself. I think the first one, which is always an easy one, if you have a house, is an easy one. If you have this debt that you need to be paid off towards the bank, you should have a form of life insurance, not mortgage insurance, but life insurance. Which we can always talk about that later, but you should have own personal life insurance that in case of your death, that mortgage can be paid off. One of the other ones you can talk about is if you're married or common law. So if there is someone who is dependent on your income.
Right.
To survive. So such as like myself, I have my wife, she'd be dependent on my income. If something was to happen to me, that income is going to stop. So we need to have that income replaced. We're talking about kids as well. If you have children, they're going to obviously be dependent on your income as well. So if you have children, this is something you should be looking into. But I think one of the other ones people don't think about a lot is that dependent can also be stretched to your parents themselves. Like if your parents are dependent on your income, or maybe not even your income, but your ability to help them. I know there's a lot of people who their parents are nearby and they'll go pick up groceries, or they'll drive their parents to the grocery store or go help them clean, those types of things. I'm like, if something was to happen to you, they might need income to help now replace that groceries or ability to go to the grocery store or the extra costs associated with it. And then lastly is always goals. Everything always goes back to, okay, what's your goal? What's your plan in the end? Because there are people who have charitable donations or different things they would love to give money to, that you can do it through life insurance. So if there's something that's important to you, like Heart and Stroke, Cancer Society, those types, or any other type of organization that you volunteer your time with, you may want to donate money to them. You can do that through life insurance with basically pennies on the dollar doing it.
So how do you figure out how much you need?
It's a challenging question. We can do the basics when we go through it. And I think a starting point for a lot of people, if they're just even thinking about insurance, and we say, okay, outside of, if you're looking at, well, let's start with the easy one. If you're looking at income replacement because you have dependents, you have a spouse or you have children and you need to make sure your income's still there, the general rule of thumb is 10 times your salary. Is usually your annual salary is where to start from. So it gives you a ballpark when you're looking at insurance, how much do you actually need?
Who can afford that? 10 times.
10 times? A lot of people, because we'll talk about it more, but there's different types of insurance, unless you want me to go into it, but I'll talk about who can afford it. So insurance is not as expensive as you think it is, because there's different types of insurance. There's permanent insurance, which is insurance that'll cover you from now, from whatever your age, so 30 until age 100. So we're talking 70 years. Or there's insurance that is just used for a short period of time, which we call term insurance. So that's the one where it's, in this case, if we're talking about just income replacement, you're looking at just a set period of time. So if you're 30, you're only in theory looking at 30 or 35 years. You're only buying insurance for that short period of time. So because I'm only buying insurance for 30 to 35, not 70, because I'm not going out to age 100 like permanent, the cost is lower.
All right, if you say so.
Well, it's because it's based on what is the risk of you passing away. Obviously, the older you get,
right,
your risk of passing away increases.
Up. Yeah.
So when you buy a 30 to 35, you're covering your risk for just that 35-year span. That, yes, there is a chance of you passing away. That's why we buy it, but it's very low versus permanent, which is to 100. So the insurance carrier looks at it and says, okay, if you're buying $1 million of term 30 at 30 years old, the risk of you passing away is far lower versus buying $1 million of whole life insurance or permanent insurance that's going to cover you for your entire life. So the cost is very different. In terms of 30-year-old getting a term 30, term 20 of $1 million, under $50, even less than that at times, $50 a month. So nothing drastic. It can be down as low as 25 at times, depending on your age and the amount of coverage.
So mine is a lot because I'm old and unhealthy. Is that what you're telling me?
Yes. Sorry.
As long as I know. All right. Okay. Go ahead.
So proceed back. So we're talking about how much you need. So I think starting off to give you a ballpark is usually 10 times the income amount is kind of like the rough figure. I always look at it as, if you're doing income replacement, it's going to be okay to retirement is what we're looking at. So based on your current age, how much money, if you were to pass away today, would your family need until retirement? Or at least that spouse who's dependent on your income, how much money do they need? And that could be income that's needed because they need that money to survive. That could be income because, okay, they still need that retirement income. That's to help support the children. There's all these layered amounts into it. But then what I do, because I think a lot of people, when I'm talking about insurance and I'm saying right now, okay, 30 years, we're saying you need $1 million. But in 15 years, I'm not going to need $1 million because it's half the amount of time, right? You catch me on that one, Wendy. So
I follow.
You follow that one. So what I do is I do a thing where I layer insurance coverage amounts over time. So I buy a different sets of term insurance, and over time you drop the amount of coverage as you get closer. Because right now it's $1 million, but in 10 years it may only be 600,000, and then 10 years later it'll only be 300,000 you would need. So we buy different portions of life insurance of a term 10, a term 20, a term 30, which is life insurance that lasts for 10 years, 20 years, and 30 years. And we do easy math. We'll just say 300,000 of each. So you're covered right now, 900,000. After 10 years, we remove the term 10. Now you just have 600,000. After the next 20, we drop the other one. So the nice thing is the amount of the cost of insurance actually decreases over time. So you're actually paying less rather than having this full coverage that you may not need and actually be over insured.
Keeping in mind also that the premiums will rise, right?
No, on the term insurance, yes.
Okay.
So a term insurance at the renewal, so after a 20-year period, so if you buy a term 20, that premium is guaranteed for 20 years.
Okay.
And then at the 20-year premium, it would automatically renew to a new premium based on your age at that time. So that's also why those term policies are cheaper. And usually you drop it at the term is done. You don't need it anymore. You wouldn't keep the coverage because it can go upwards of 10 times and it's very, very expensive.
Well, I mean, and I'm not saying you're wrong, but you're wrong. No, I'm just kidding. But every time we go up an age box, it increases.
Yes. Yes, absolutely.
That's not waiting until the term's up. That's when I turn a certain age, I get bumped up into that category.
If you haven't bought the insurance, yes.
No, I have the insurance. I've been paying on the insurance for 10 years.
So you have then your policy then. So I know what your policy is. Yours is a YRT or an ART or a yearly or annual renewable term policy. So your
Oh.
policy every year renews to a new premium every single year.
Huh.
Like I have insurance that I bought when we bought our house for 400,000 because I lucked out and got a house when the mortgage is like 400,000. It's the same amount. I don't pay a penny more. It's the same $23 a month.
Okay.
And that's it. And it's been the same. And it's going to be going until that premium, until that term is up. So, yeah.
I made all the wrong decisions, is what you're saying. Yeah. Okay.
Yeah. So
Yay
yes,
me.
there are. Yeah, you that but now you know. So you need to go talk to your broker and say, hey, I want a guaranteed flat premium, not this every year increase time, like again and again and again.
Right. So this is why you should lock in when you're younger.
No, I don't like that. The locked in when you're younger fight. Well, I'd say it's a sales tactic. I guess is the right way to say it. Um, I'm looking at it from the standpoint of when I'm talking about locking in younger, though, I'm thinking, okay, if you're 23, just starting a job, not married, no kids, parents are dependent on you, like there's really no need for you to have insurance. Buying insurance when you're 23, I don't think there's a value add to you at that point. You're buying something that, yes, you may need in the future, but you really don't know because you're 23. You may be single, not planning on getting married till you're 35, maybe don't want kids or unsure if you want kids. There's all these things. It'd be like saying, oh, well, if I'm 23 and go, well, I know I want kids, so I'm going to buy that minivan now when it's cheaper and just have it and store it in a garage just in case I need it. Like, why would you buy a minivan when you're 23 if you don't need a minivan? Like,
Okay.
it doesn't make sense to me. So I think there's probably for people who are 23 who don't have dependents, aren't married, don't really have a need for insurance, at least life insurance. They would first look at critical and disability insurance first, because I would say, yes, get that. But then focus on your investments at that point when you're 22, 23, if you don't have the need for life insurance. Make sure, yes, if you're injured or become sick, your income can be replaced for yourself. But and then look at life insurance when you need it later on, when you buy that mortgage and those items, because the cost, yes, does increase. Not going to deny that fact. As time goes, the cost is going to increase, but it's not drastic between 23 to 26. You're not talking huge amounts of dollars. It's not jumping from $20 to $80 a month unless something happens to you medically, but you cross your fingers and hope it doesn't. I'd say it's smarter to buy the critical, the disability, and put that money into your emergency fund and your investments and your goals and all these other things you want to achieve first before you buy life insurance.
So if I decide to, do the right thing, I'm going to get life insurance, 30 years old. It's a smart thing to do. I'm going to lock in that low price, even though we don't like that term. But then I'm done. Then I don't have to worry about it, right? I'm taken care of. I'm good to go. Never have to think about it again.
No, because it's this.
The wrong answer.
No one's life stays the same. Like, you're wrong, Wendy. I would throw back at you. Well, because whose life stays the same? Like, when you're 30 years old, your income needs at 30 isn't going to be the same when you're 50, because over that time frame, your inflation's going to eat away at the money. You're going to have raises as you go on, because when you're 30, in theory, most people are going to be making more money. So your income needs are going to go. Your lifestyle is going to change over the next 30 years with either additional kids or cottages or upgrading your house to higher mortgages. So when you're 30, we're calculating what is your need based on that day. How much money do you need? But then as things change, yes, you're going to need to increase that
Okay.
coverage to now help you set with the new goals. Like I have clients right now where 4 years ago, they came to me, need insurance. They were newly married, wanted income replacement. We set it out, the income replacement based on their current needs. What were they making today? How much coverage did they need to ensure that the money would still flow should something happen? 4 years later, just chatting with them, one of them has raised and now their income's doubled. And now their goals have changed drastically because now they have this extra money that they didn't have before. And now it's, well, now we'd like to do these and we want to do this. So it's now, okay, we need to actually increase the amount of life insurance you need at this point because now you have these other goals and there's more income to replace. We now need to make sure that money is still there. So now we're buying a little bit more additional insurance on top to cover them to make sure, okay, they can still reach that new goal.
So the work's never done.
No, the work is never done. It's never a one and done. Nothing in financial planning or insurance is like a one and done. It's never just like meet me one time, get the insurance, and I'm good and I'm set for life. It's like, no, it's not that easy.
That's what I want. This sounds exhausting. I don't like it.
It shouldn't be exhausting, Wendy. That's why it should be exhausting for you. It's exhausting for me because I do all the background work and all the calculations on my spreadsheets and do all these things. You just say, oh, my life has changed. Maybe I should look into this and say, Aaron, figure this out. Take it off my plate and do it for me, please.
Do it for me now. All right. So, Aaron, what about permanent insurance? Is this something that everybody should consider?
No. Permanent insurance has its place in everyone. It has its place, but I don't think it's for everyone. Not everyone has a need for permanent insurance based on their goals. Most 30-year-olds, even 40-year-olds probably don't need permanent insurance at that point because the hardest thing to even figure out when you're 30 and 40-year-olds is how much insurance are you going to need in theory if you live till 90? Because and I say that because permanent insurance has its place in terms of estate planning. So when we're thinking end of life, we're thinking, okay, 90 years down the road. We're thinking when you're 90 and you now have potentially tax implications, maybe a second house, grandkids, charity donations, but we don't know what's going to happen. We're guessing at 30, what are the rules going to be in 60 years? I have no idea. It's changing all the time here. Like they brought in capital gains taxes in Canada and then they've now pulled it back. So now it's not happening. We've got tariff wars that were happening, aren't happening. Now I think they are happening. I don't know what's going on. So I don't think it is. So it has a place if you're young and you absolutely believe in it. And it has a place because you're concerned about having money later in life or there's a charitable donation or something you want to do, but you could easily cover it with even term insurance. So even if you're younger and you're 30 and you're like, you know what, I have this charity that's important to me because my parents had cancer and I really want to give it to the Canadian Cancer Society, we can add that amount into the term insurance. We can look and say, okay, how much money would you like to give? Well, I'd like to make sure there's $50,000 for him. Okay, we'll up your term insurance by $50,000. We'll add that into your will. That $50,000 goes to here, making sure it's in the beneficiary. That X amount goes to that cancer society, and it's taken care of for you. Like I have permanent insurance. Like I don't deny it. Like I do. I have some, but I have it specifically for a reason. And that reason is I know in the end, I'm going to have a huge capital gains later on in my life that I know I need to pay off. So I want to make sure that that coverage is there to cover it. And that's why I have it. I don't have it for a reason that I'm younger and I can buy it cheaper versus not, or the cash value into it. I have it specifically set for my estate planning, my taxes, and making sure I'm covered off in the end.
All right. Well, that sounds smart, Aaron.
Smart for a change? Is that what you're trying
to... I wasn't trying to say that. Apparently, I didn't have to.
Thanks for that. I'm sore. I'm tired.
So you schooled me today. You taught me that I have the absolutely wrong insurance. So I need to amend that for sure.
Yes, I would absolutely amend that. I said I've sold YRT one time in this 10 years. I've sold it one time to one client, and that was only specifically for the fact that the client was trying to quit smoking. And so
And they
smokers pay
wanted
more than
to,
non-smokers.
yes.
So they wanted the lower rate, but we couldn't get them locked in. And then and the smoker rate was it was far more expensive. But two, there were a couple medical issues that could have been reconsidered in a few years. So we went to the YRT specifically for the lower cost, just for the 2 years. And then we switched them into the permanent once they had quit smoking. And once the medical issues were all covered and cleared off, then we moved them into the guaranteed level premium. So now they're paying straight level costs. That's it for the time being, rather than those increasing costs, because they got expensive if you ever look at them.
Oh, yeah. I did. Yeah. So
That's probably the one tip I can tell people. If you're buying term insurance, do look at what the conversion is later, because people get caught up on that too. Is people will buy term 10 insurance, which is guaranteed for 10 years, because the cost is cheaper than a term 20 or even like term 30 insurance, but the cost skyrockets after 10 years.
okay.
So what'll happen is, yes, term 10, it may be $30, but after 10 years, that cost will now go from like $30 to $300 a month. So it would have been, the smarter move would have been to purchase the term 20 at 50,
Right.
because it would have been $50 flat versus that. So always, if you're looking at term insurance, look at what is the renewal cost every year. So don't just look at the first, what am I paying monthly? It's what am I paying over the long term? What am I trying to cover, and what's the total cost of that insurance coverage?
All right. Good information. Thank you so much. And if people have more questions about this term, permanent, all of the RTF life insurance, I just made that one up. How do they get in touch with you?
They can find me on prickfree.com, and you can always email me at Aaron, AARON, at prickfree.com as well.
All right. Well, thank you, Aaron. It's a pleasure as always.
I'm glad I educated you a little bit. Now you have work to do, so it's good for me.
Well, I sound like I always have work to do. Thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time.
Thank you for listening to the No Pricks Allowed podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.prickfree.com or give us a call at 613-876-9899. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Cactus. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The contents of this podcast do not constitute an offer or solicitation for residence in any other jurisdiction where either Aaron Buchner and/or Sterling Mutuals is not registered or permitted to conduct business. The opinions expressed are those of the authors and do not necessarily reflect the views or opinions of Sterling Mutuals, Inc. Mutual funds provided through Sterling Mutuals, Inc. Commissions, trailing commissions, management fees, and expenses all may be associated with mutual fund investments. Please read the prospectus carefully before investing. Mutual funds are not guaranteed, their values fluctuate frequently, and past performance may not be repeated.